price moved. Did you see it? Not silver, not gold, the thing nobody's watching, the thing that's supposed to be boring, safe, stable. The 10-year Treasury yield spiked 18 basis points in 4 hours, then pulled back, then spiked again. That's not a data point. That's a heartbeat skipping. That's the plumbing starting to crack. And when the plumbing cracks, everything above it floods, fast. Most people don't respect bonds. They think bonds are for retirees who wear khakis and argue about decimals. They think stocks are where the action is. They're wrong, dead wrong. Because bonds are the foundation. Bonds are the collateral that holds the entire financial system together. And right now, that foundation is showing fractures. I am Ken Au. Welcome to the Vault. Today, we expose the tripwire nobody's watching. And by the end, you'll understand why the next move in gold and silver won't be gradual. It'll be violent. Let me show you what's actually happening. Not the headline version, the mechanism. The thing they don't explain on CNBC because explaining it would cause the panic they're trying to avoid. Government bonds aren't just an asset class, they're collateral. They're what financial institutions use to prove they're stable. They're what pension funds park money in when they pretend they're being cautious. They're what the system treats as the closest thing to risk-free. So when the risk-free asset starts wobbling, the entire concept of safety gets questioned. And when safety gets questioned, people don't calmly rebalance their portfolios. They stampede. Here's the framework. In past market blowups, the spark came from places that were big but still contained. Tech mania blew up in 2000. Housing blew up in 2008. Those were massive events. But this time, the problem is sitting in the place governments and central banks cannot afford to let fail. Sovereign debt. Except printing to pay it back is the same thing as destroying the value of the currency. And that's where gold and silver enter the story. Not as speculation, as the escape valve when the system admits it has no other choice. This is where things stop making sense for most people. They look at the bond market and see calm. They assume everything's fine, but calm isn't the same as stable. Calm can be the moment right before the structure gives way. Here's what most people miss. Bonds don't have to move a lot to be a lot. When you're talking about instruments used as collateral and held with leverage, a move that looks small on paper can be catastrophic in the real world. A couple of rough days can tighten funding markets. And once funding tightens, liquidity disappears where you least expect it. The short-term lending and collateral ecosystem is the heartbeat that keeps large institutions functioning day to day. When bond prices drop, collateral value drops. When collateral value drops, borrowers have to post more or lenders pull back. When lenders pull back, you get a chain reaction that looks calm on the surface until suddenly it isn't. Think of it like a building with a crack in the foundation. The crack starts small, nobody notices, but the stress is redistributing. And then one day, without warning, something gives. Not gradually, all at once. Let me show you the escalation sequence. Stage 1. Bond prices drift lower. Yields tick higher. The media calls it normalization. Nobody panics yet. Stage 2. The drift accelerates. A weak auction. An intraday spike blamed on positioning. The cracks are visible now, but only to people paying attention. Stage 3. Forced selling begins. Leveraged players get margin calls. Systematic strategies rebalance. The selling creates more selling. Stage 4. Liquidity vanishes. Bid-ask spreads widen. Market makers step back. This is when the whispers start. The denial phase ends. Stage 5. Policy response. Central banks step in. They don't call it panic. They call it ensuring market functioning. But the effect is the same. New money enters the system to stop the bleeding. And that new money? That's when gold and silver stop being boring insurance and become rocket fuel. This move was prepared. The timing wasn't accidental, because when central banks step in to support bond markets, they have exactly two choices. Let yields rise and let the pain spread, or add liquidity to calm markets and accept the inflationary consequences. They always choose door number 2. Always. Because letting bond markets collapse means letting the entire financial system collapse. Pension funds blow up. Insurance companies go insolvent. Banks face margin calls on their treasury holdings. So they print. They don't call it printing anymore. They call it quantitative easing. Liquidity facilities, emergency operations. The language changes, but the mechanism doesn't. And when they create new currency units, the existing currency units lose purchasing power. That's not theory. That's mathematics. More units chasing the same goods and services means each unit is worth less. And what holds value when currency units are being created by the trillions? Hard assets, real assets, the things that can't be printed into existence. Gold, silver, the metals that have survived every currency collapse in human history. Let me show you why silver is the dangerous one, not gold. Silver. Gold is the heavyweight. Gold is respected. Gold is dignified. Gold is what central banks hold openly. Gold moves with a certain elegance. Silver is the wild card. Silver is the market that looks dead for years and then detonates without warning. It's smaller, it's thinner. The available float is tiny compared to investment demand during panic phases. When the crowd rushes in, there simply isn't enough supply sitting around at current prices to meet that wave of demand without the price jumping violently. That's why people who've watched this market for decades keep saying silver can outpace gold when the cycle turns. Not because silver is more important historically, because it's more sensitive mechanically. Because it's the market where a relatively small amount of capital can move the price massively. Look at the gold to silver ratio. For long stretches of history, that ratio sat in a range. In recent decades, that ratio has stretched to extremes. Gold priced at 80, 90, sometimes over 100 ounces of silver. That's not normal by historical standards. That's a rubber band stretched to the breaking point. And when stretch relationships snap back, they don't politely return to average and stop, they overshoot. Because human behavior is emotional and markets are the sum of human behavior. So here's the pattern nobody wants to see. The pattern that repeats every time the bond market cracks. Bond stress emerges. Policy response follows. Liquidity floods the system. Currency purchasing power erodes. Investors flee to hard assets. Gold rises first because it's the safe, respectable play. Then silver catches fire because it's the high beta version of the same trade. But silver doesn't rise politely. It doesn't grind higher in a steady line. It explodes. It gaps. It makes people's heads snap back. It forces positioning changes. It creates FOMO. We've seen this movie before. 1979, 1980. Silver went from under $6 to over $50 in less than 2 years, 2010, 2011. Silver went from $17 to $49 in less than a year. Same pattern, quiet accumulation phase, then detonation. And each time the excuse is different. In 1980, it was the Hunt brothers. In 2011, it was QE2 and European debt crisis. But the mechanism is always the same. Bond market stress, policy response, currency debasement, flight to hard assets. We're watching the setup phase right now. The bond market is showing cracks. Not a collapse yet, just cracks. Weird auctions, intraday volatility, yield spikes that don't fully reverse, the early warning signs. But silver has another layer most people completely ignore. Industrial demand. Silver isn't just a monetary metal. It's embedded in electronics, medical equipment, water purification, and the big one people underestimate, solar technology. When governments push electrification and energy transition mandates, silver demand doesn't politely step aside. It shows up with force. And here's the trap for the market. A lot of silver isn't sitting in vaults waiting to be sold. It's embedded in products. It's in supply chains. It's held in forms that don't immediately come back to market. So when investment demand surges, the available float feels smaller than people assume. Unlike commodities where new supply can ramp fast, silver supply is stubborn. Most silver is produced as a byproduct of mining other metals, copper, zinc, lead. That means even if silver's price rises dramatically, you don't instantly get a flood of new production. So you've got a market that can get a demand surge from investors and industry at the same time while supply growth lags. That's not a guarantee of $500 silver tomorrow, but it is a setup for violent repricing when the financial side panics. Someone knew this pattern. And they positioned for it. Look at central bank behavior. Not what they say, what they do. Central banks have been accumulating gold at the fastest pace in decades, not because they're nostalgic, because gold is outside the paper promise system. When your job is to manage a currency and you're watching the global debt load explode and you're watching other central banks print aggressively, what do? You hedge. You buy the asset that has survived every monetary regime in history. They don't announce it with fanfare. They just buy, quietly, consistently, month after month, because they see the bond market stress. They see the fiscal trajectories. They see the trap. And if central banks, the institutions that print money for a living, are buying gold to hedge their own currency risk, what does that tell you about where this is headed? Now let me show you the historical precedent, because this pattern has run before. 1970s, stagflation. Bond yields exploded from 6% to over 15%. Bond prices collapsed. Investors holding long-term treasuries got destroyed. The safe asset turned out to be the most dangerous thing you could own. And what happened to gold? Gold went from $35 in 1971 to $850 in 1980, a 24x move. Silver went from $1.50 to $50, a 33x move. Not because metals suddenly became more useful, because the bond market forced the Federal Reserve to admit they'd lost control of inflation. 2008, 2011, financial crisis. The Fed slashed rates to zero, launched QE1, QE2, Operation Twist, bought trillions in treasuries. Gold went from $800 to $1,900. Silver went from $9 to $49. Same pattern. Bond market stress, policy response, metals explosion. And now? We're in the same setup, except the debt levels are higher, the policy tools are more aggressive, and the potential for disruption is larger than any prior cycle. The difference this time is speed. In the 1970s, the inflation crisis took a decade to build. In 2008-2011, it took 3 years. The next cycle could compress into months because the system is more leveraged, and the policy response has to be more extreme to generate the same effect. That's why waiting for confirmation is suicide. By the time it's obvious to everyone that the bond market is breaking, the metals will have already repriced. You won't be buying silver at $30. You'll be chasing it at $60, $80, $100. Let me show you the timeline that matters. Phase 1, nobody cares. The diehards accumulate while everyone else mocks them. This phase can last years. Phase 2, the move starts. Price breaks out of the range. People argue about whether it's real. The market shakes out weak hands with violent pullbacks. This is where most retail gets frustrated and sells. Phase 3, the move becomes obvious. The crowd shows up late. FOMO kicks in, headlines start appearing. Financial advisors who called it a barbarous relic 6 months ago are now recommending 5% allocation. Phase 4, the mania phase. Price goes vertical. Everyone has an opinion. The blow-off behavior emerges. Most people think we're still in phase 1. I think we're transitioning from phase 1 to phase 2. That's the most dangerous phase. That's where the violent shakeouts happen before the real move begins. And here's the trap. If you wait for phase 3 to confirm the trade, you've already missed the easy money. By the time it's obvious to everyone, the risk-reward has flipped. Now let's talk about miners, because miners are the leverage on the leverage. Mining stocks are the awkward middle child. People either love them or hate them. But miners matter because when metals rise, miners can explode. The math is simple. If a mining company produces silver at $20 per ounce and silver is trading at $25, they make $5 profit. If silver goes to $50, they're making $30 per ounce profit. Revenue went up 2x, profit went up 6x. The stock doesn't just double. It can go up 5x, 10x. That's the leverage. But miners have been psychologically abandoned. Bad capital discipline in past cycles, dilution, cost inflation. So the market has priced them like the metal price will never stick. And that creates the opportunity, because when the market finally believes the move is real, the repricing can be violent. Capital that was sitting on the sidelines suddenly rotates into miners seeking torque. And if silver leads, silver miners become the part of the trade that people talk about at dinner parties. The stories of 500% gains. But it only happens if the bond market forces the policy response that legitimizes the entire thesis. This is where the system starts leaking. Bond market stress isn't isolated, it travels. When bond prices fall in the US, it affects collateral values globally. When collateral values drop, foreign holders adjust. Pension funds rebalance. Banks shuffle balance sheets. And don't assume this is only a domestic story. When major economies all have heavy debt loads and all face demographic challenges, the temptation is the same everywhere. Keep financing easy, keep the system afloat, kick the can. That means currency debasement isn't a one-country story, it's a global phenomenon. And in a global debasement scenario, hard assets become the common denominator. That's why you see coordination, central banks moving together, policy shifts happening in clusters, because they're all trapped in the same system. And they all know the bond market is the pressure point. Let me show you what to watch, because the signal won't come from CNBC. Watch for days when yields spike and don't fully come back. Watch for auctions that feel soft. Watch for the language shift from inflation fight to financial stability. That's your signal. Watch for foreign holders reducing exposure. When China or Japan start trimming treasury holdings, that's not portfolio management. That's loss of confidence. And loss of confidence in the world's reserve currency is the ultimate trigger for hard asset repricing. Watch credit spreads. When corporate borrowing costs start widening even as stocks hold up, that's stress transferring from government bonds to private credit. And when private credit freezes, the cascade accelerates. Watch real yields. The nominal yield minus inflation expectations. When real yields go negative, bonds are guaranteed to lose purchasing power. That's when rational investors flee fixed income entirely and rotate into assets that can't be debased. Not a tweet from a celebrity, not a Reddit post, not a headline. The signal comes from the plumbing, from the boring part nobody's watching, from the bond market cracking while everyone's staring at stocks. Let me show you the positioning strategy, because understanding the thesis is worthless if you don't know how to act on it. Tier 1. Physical metal, gold and silver you can hold. Not ETFs, not futures. Physical bars and coins in your possession or in allocated storage. This is the foundation, the insurance policy, the thing that can't be confiscated or diluted or hypothecated. Start with gold if you want stability. Move to silver if you want volatility and upside torque. But get something physical before the crowd arrives. Because when the bond market cracks and the policy response comes, retail availability will vanish overnight. We've seen this before. March 2020, pandemic panic, mints shut down, dealers sold out. Premiums exploded to $10, $12, $50 over spot. The paper price said $15, the street price said $30. And if you didn't already have metal, you couldn't get it at any price. That's the lesson. The paper market and the physical market can disconnect violently during stress. And when they disconnect, the paper price becomes irrelevant. What matters is whether you can actually acquire the metal. And in those moments, you can't. Tier 2, miners. The leverage play, but be selective. You can't just buy anything with gold or silver in the ticker and expect magic. You need quality, strong balance sheets, proven reserves, management that understands capital discipline. Focus on producers, not explorers. Producers generate cash flow today. Explorers burn cash hoping to find something tomorrow. In a bull market for metals, both can work, but producers survive the pullbacks. Explorers get obliterated. And here's the key. Miners will lag at first. When gold and silver start moving, miners often don't follow immediately because the market doesn't believe the move is real. But once miners break out, that's when generalist money rotates in. That's when the real explosions happen. Tier 3, for those who understand risk. Out-of-the-money call options on quality miners. Futures positions if you can manage leverage. These instruments can generate 10x, 20x returns if the thesis plays out, but they can also go to zero if timing is wrong. This isn't the foundation. This is the satellite bet. The asymmetric trade. The thing you do with 5-10% of your allocation if you want to amplify gains. But never make this the core position, because timing leverage is nearly impossible. And here's the final piece, psychology. When silver first starts running, most people don't believe it. They call it a fake out. They say it's overbought. And sure, silver does get slammed. That's part of its personality. But the bigger risk is waiting for the perfect dip that never comes, waiting for confirmation that arrives after the move, waiting for permission from financial media that only acknowledges trends after they're over. The winning strategy is building positions before it's comfortable, before it's obvious, before your friends think it's a good idea. Because by the time it's comfortable and obvious, the easy money is gone. And when the move really takes hold, it won't feel safe. It'll feel insane. You'll question yourself every day. That internal voice will scream at you to sell. And most people will listen. They'll sell at $40 silver, then watch it go to $60. They'll buy back at $65, then panic sell at $55. They'll torture themselves trying to time every wiggle instead of holding through the noise. The people who win aren't the ones who trade perfectly. They're the ones who understand the thesis, build the position, and hold through the volatility. Let me give you the open-ended warning. The bond market is too big to be ignored. If it breaks down, it forces choices nobody wants to make. Higher yields destroy the economy. Lower yields through intervention destroy the currency. There is no clean exit. So policymakers will choose the path that's politically survivable in the short term. They'll print. They'll intervene. They'll call it ensuring financial stability. And they'll accept the long-term consequences because the long term is somebody else's problem. And when they print, hard assets rise. Not because gold and silver suddenly became more useful, because the currency became less trustworthy. The denominator changed. Gold is the anchor. Silver is the accelerant. Miners are the leverage. And the bond market is the tripwire that starts the cascade. If you're watching this and you've already been stacking, you're not crazy. You're early. There's a difference. If you've done nothing, you're not doomed, but you are on a clock. Because the moment silver starts making new highs and holding them, the entire psychology changes. The jokes stop. The dismissiveness stops. The should I buy questions start pouring in, usually when the easy money is already gone. So watch the bond market. Watch for the signals in the plumbing. Watch for the language shift from inflation fight to financial stability. That's when you know the policy response is coming. And that response is rocket fuel for hard assets. And when that signal flashes, the move in gold and silver won't give you a polite invitation. It'll happen on a week when everyone's distracted. And then suddenly, the price is gone. The trap is set. The tripwire is visible if you know where to look. The bond market is telling you something. The question is whether you're listening. By the time the mainstream admits what's happening, the window will be closed. The metal will be gone. The miners will be priced for perfection. And you'll be standing in line wondering how you missed it. History doesn't repeat because people learn. It repeats because people don't. They ignore the warning signs. They trust the system. They wait for permission to protect themselves. And by the time they realize the system won't protect them, it's already too late. The bond market is the tripwire. Gold and silver are the escape valve. The cascade is loading. The only question is whether you'll see it coming or be the one asking how you missed it. The signal is being sent, not by conspiracy theorists, by the data, by the bond market, by the cracks in the foundation. You've been warned.